What's up, guys? This is Tyler here from Foundation Investing, and I'm here today to present the next installment of our economic indicator series, Retail Sales. So let's get started. So what is the Retail Sales Report? Well, it's released on the second week of each month, and it's created by the U.S. Census Bureau. And so what they do to create this report is conduct a survey from a sample of 4,700 employer firms that notate how their sales are going for the current month. Okay, they show numbers from retail broken down to every category you could imagine. And then they compile the data and they report percent changes for prior months or years. Okay, and it's key to understand here that it's not about the absolute sales data, it's about the percent change from the month or the percent change from the year before. That's the big thing that Wall Street cares about. So here's what a month over month graph looks like for US retail sales. And as you can see here, it oscillates between 2 and negative 2%. So the fluctuations aren't that large. It's pretty choppy. It's pretty noisy. And personally, I don't like looking at this because it just indicates too much noise to me, although you'll hear the media report this number a lot. Here's the year over year number. Okay, so this compares for instance, the November 2015 retail sales over November 2014. And what you can see is this thing tends to trend. It's a little bit easier to read, and you can tell a little more from the graph, and it oscillates between plus 10% and around minus 10% in very brutal recessions like 2008. So there's two primary numbers that are reported. It's called total and X autos. Okay, and the analysts cut up the data to spot trends this way, and the reason why they have an X autos number is because the auto segment of retail is one of the most volatile, and it also is a very high ticket price. So sometimes if you take that out, you can spot more stable trends. And the same thing is true with food and gas. So you'll see analysts go and cut out a bunch of stuff from the total and look at certain industries and sectors to try to get a more stable trend plotted on the graph. But the two most important ones are the total, including everything, and X autos. Now here's a picture of the report just so you can see what it looks like instead of just reading on the news as a data release. So if you dig down, you see here on the top two rows, retail and food services total, and then total excluding motor vehicle and parts. Those are the numbers that are reported. So the first October 2015 column, that's the percent change from the month. So this is the November report. So November 2015 sales advanced 0.2% over October 2015. And from a year ago, November 2014, advanced 1.4%. And remember, the row right beneath there was the X auto numbers. So those are the two main things that are reported. You can see here on the report, though, there's a lot of other things that you can look into and kind of dig down in case you are a big owner of health stocks and food stocks or electronics, certain things like that. You can dig in and see what are the trends in that particular sector of retail. So here's what it looks like against the SPX. I plotted the retail sales year-over-year change in conjunction with the SPX just so you could see how the market moves in comparison to this data. Now, I wanted to test a couple assumptions that I made from that data or from that chart, and we conducted a study, and here's what we did. We looked at all instances where retail sales numbers year-over-year between negative 3% and 3%. So the readings were negative 3 to 3, anywhere in that range. And then we looked at the 12-month SPX returns after that reading. We also looked at all instances where retail sales numbers year-over-year were below negative 3%, so extreme negative returns, negative 4, negative 5, anything below 3, even negative 8 in the 2008 Great Financial Crisis. And we calculated the 12-month returns after those readings, and this is what we got. So the results are pretty cool. So any time that retail sales prints between negative 3 and 3, we actually see the market go down 69% of the time. So what you can see here in the table is the first thing says there's 39 occurrences of a negative 3% to 3% reading. And then the second cell there says there's out of those 39 occurrences, 27 of those, the market finished lower for a total of 69% down. That's pretty compelling. That means that when retail sales is weak and kind of in that 3%, negative 3% band, it's watch out for a bear market, watch out for a recession. Doesn't mean it's guaranteed, but definitely watch out to see what the price action is doing and if we can enter into a bear market. Now, if retail sales have extreme negative readings below negative 3, there was 13 occurrences of these since 93. 12 out of 13 times the SPX actually finished higher, and that's a 92% chance that the SPX finished higher if there is an extreme negative reading. Okay, so what that tells me is if it's super low, then that might signal it's possibly bottoming out of the market, and a possible bull market can come out of that from oversold conditions. So those are the main takeaways from the study, and the reason why we do these studies that's so important is because we want to know how these economic indicators can make us money. Okay, at the end of the day, it's nice to know what they are. It's nice to know how to access the report, how to read the report, but unless you can take that report's data, put it into your investment process, and create cold hard cash out of that, it's pretty much useless as far as we're concerned. So remember, small positive and small negative retail sales numbers signal pullback or recession is likely, and extreme negative retail sales readings mean stocks are oversold and business cycle is very likely to mean revert. That's all for today, guys. Thanks for listening. If you liked the video, please give it a like down there, comment, subscribe, share with your friends. We hope this will help you make some money in 2016.